Candle Range Theory Trader, another video talking about the only fair value gap that is worth trading if you're using the candle range theory. So let's not waste time and get into it. Now, the most important thing to remember is this. This is not necessary to know. This is a little bit of a high risk of a proposal. However, I'm going to just show you this to you because it may resonate with some people and some people will choose not to use it. That's fine. It's not necessary. This is not a must-know system. It really isn't, or method. Simple is always best. The less steps your trading system has, the better it's going to be. So here we go. In understanding the candle range theory, you want to understand that one of the main models that people use is the three candlestick pattern, whereby they go with candle one, candle two, candle three. In this case, we're going to go ahead and say we're going to use this with the daily model, or this could be even a weekly model. Okay, so, but let me just stick with the daily for now. So you have 3 days. The days don't matter. It could be Monday, Tuesday, Wednesday. It could be Tuesday, Wednesday, Thursday. It could be Thursday, Friday, Monday. It doesn't matter. The point is the price action. All right, so we have this. It's a high, higher high, lower high. Okay, and this is just a example of how it would look on a chart, where what you want to see price do. In a short example, price goes up. Like this price action right here goes up above Monday's high and then closes down to the low. Okay, down there. This is a long example, just flipping that chart upside down. I think we all understand that. Okay, there's more videos on that concept if you don't exactly understand what the candle range theory is. The only fair value gap that's worth trading, okay, is the first fair value gap that is created off the high or low of the day on the 15-minute chart. Not the 5 minute, not the 1 hour, not the 1 minute, the 15-minute chart. Okay, so here's how that would look on a scaled down chart. Okay, to keep it simple. So let's just say we have a daily chart here. Your trading day in this example would be Tuesday. This is going to be Monday's high, this red line. This would be Monday's low. Price goes above Tuesday, then it starts to show momentum going to the downside. It creates a fair value gap off of the high, and then ideally close back inside the range and then continues to tank. Most of my videos talk about trading at this level. What the difference between this model and most of the models that I talk about on this channel is that we're actually trading the manipulation, what's known as the manipulation phase of this move, or the money candle. Either way, doesn't matter. Okay, but you're trading above the range. You're trading above the range. All right. So, and then for a long example, you're trading below the range. But whatever the first fair value gap is that is created on the 15-minute chart, when price retraces back into it, that's your signal to get in. So you can use a fair value gap indicator on TradingView. There's more than enough on there. I use the one by a gentleman named Nephew Sam, but just type in fair value gap on TradingView indicators and you should be able to find one, no problem. So let's look at a couple of examples. Here's a real example from Euro New Zealand. So you have here, this is the prior day high, this red line. Prior day low is this green line. Price goes above the prior day high, chops around. Okay, the mark levels indicator will show you the high of the day. That's marked right here. I call this the money candle. It's the money candle because there's only going to be one high of day, and only one candle is going to designate that. So step one, the price has to be trading above the prior day high. It's doing that here. Step two, there has to be a break of the money candle. So what does that mean? If you're going short, the low of this 15-minute candle has to be closed below. That happens right here at 2 a.m. So when 2 a.m. closes right here below the money candle, that's your signal to say, okay, now I'm just waiting for a fair value gap. Now, in best case scenario, the fair value gap gets created at the same time, which it does right here. Okay, so then price retraces back into it from 215 to 315. So you have about an hour to make up your mind whether or not to take this trade. Stop loss can go a little bit above the fair value gap, or it can go above the high of the day. Okay. All fair value gaps will not be this small. Some may be fairly large. It just depends. So use your best judgment. All right. So, and then if the trade is valid, the fair value gap should hold. And notice it did hold for the rest of the day. This was during the London session, and then price tanked. In this example, it tanked 500 pips. But that is not the norm. Okay, this is just the first example I found. But this was a 500 pip drop in a day. I don't know if that was news driven or what, but that's just what happened here. Don't look for a 500 pip drop every day. It's not going to happen. What you do want to see though is this price action though, where price closes inside the range. It consolidated a little bit here, which it often does. But at the end of the day, the move should come eventually and close out the range, just like it does right here. So this, okay, or this is this, okay? So let's look at a long example now. So we have the prior day low, this green line, prior day high, this red line. So when the day opens, price goes down, okay, below the prior day low. So we look for, okay, where's our money candle? The money candle below the prior day low is right here because market levels is already going to mark that. When does it get closed above? Right here at, according to my notes, 3:30. So this candle at 3:30, right on the start of the London session, created the first fair value gap off of this low of the day. Price retraces, and sometimes it'll be right on the range. You know, you never know. But either way, you're still just looking for the first fair value gap. This is your entry zone right here, and the gap must hold. All right. So you had plenty of time to get into this one from 4:15 to 6:30. And then price went up. This went up for 50 pips. This is a much more realistic move that you should see at least once a day. Something like this. All right. So that's that. Now, in conclusion, you might wonder, wait a minute, you only showed me 2 examples. Why is that? Why don't you have like 2 or 4? Well, the first thing is everything I've shown you, it's going to take place on various charts at different times of the day, but the price action is still the exact same. If it happens once, it can happen again. Okay, so that's the main thing. It's so simple that we overcomplicate this stuff. I've showed you the whole thing. So a child could implement this system. All right. Now, if the fair value gap disappears, just get out for a small loss because you can always get back in. Usually, if the fair value gap disappears, price is going to keep right on going. In other words, if price closes below this gap, for the most part, it's going to keep right on going. It's going to take out this low. It's just going to keep, that's the trend. The trend is just down for the day. It happens. That's fine. Okay. I'm telling you that's going to happen. This is not 100%. Okay. So risk management, because of that, risk management is always going to be number one. Stop looking for guarantees because what I just showed you can and will fail. So when you lose, just lose small. You're going to lose $5, maybe lose $10, maybe lose $20. But when you win and you can scale in, if you have equity left, then maybe you can make $50, $100, $150, $200, $1,000, whatever, however big your account is. Okay, I don't know what type of funds you're working with, but the name of the game is always going to be whenever I lose small, but when I win big. If you do that, you'll be fine. Okay, but don't try to aim for, well, I got a 90% win rate. That's a waste of time. Okay, you want big wins, small losses. Okay, either a break even, a big win, or a small loss. That should be your trading goal, or even a small win. But then I'm talking to myself here too. I'm not gonna act like I got it all together. I just do know that big losses are unacceptable. Okay, you can't avoid a big loss either with stop losses or you got a price alert, something. Don't let price get away from you. All right. So, lastly, I prefer to use this on the daily range. In other words, prior day high and prior day low. Now, if I'm using this, now my prior system uses our prior entry models uses the 4 hour range, which is more than fine. But if ever I wanted to implement this, I would just use the daily. So now I'm going to show you how to backtest this on your own because again, why didn't I have more examples and screenshots? Because that's your job to prove it to yourself that this might be something that you could be interested in. So with that in mind, let's take a look now at a chart and see what we can see. So let's go to, we'll put our mark levels indicator up. It actually, all we do, if we just scan, I'm going to pick a pair at random. Let's just say pound Aussie. Okay. All I'm looking for is an example where price goes above a daily high and then closes back inside of it. So it just sweeps above the high and closes back inside of it and completes a range. And it does so right here. But I'm going to try to find one more with a little bit of a smaller wick. So either long or short. This is one here too, but I want to see something a little more succinct. So something like this could work. Yeah, I think I like this one. And you may be wondering which one I'm going to show you. Right here. Oops. Okay, hide the day right there. Low of the day right here. Okay, and I like for them to be right next to each other. I don't look for ranges that take like 5 days to complete. No, I want it to be bang bang, like a basic M pattern, leg one, leg two, with the second leg being higher than the first leg. That's my bread and butter. So that's what I like to see. So this is a Thursday, Friday. So this was on pound Aussie. So then I just use the replay option and I go here. And then I'm going to go to the 15-minute chart. And sometimes too, sometimes there may not be a fair value gap as well. I didn't mention that. And let me see if I don't. So let's see here. Okay, so for this one, there is no fair value gap. You still could have taken this trade on the close below this range, but when it traded above it, there's just no fair value gap here. So that one would be, according to the system I just laid out, it wouldn't fit into it. So let me find another one. Okay, I'm doing this on the fly, so obviously that one didn't work out. So let me try to find another one. And again, like I said, it's not necessary to know because you don't need a fair value gap to take these types of trades. It's just that if you want to trade the manipulation level, this level right here, or this price action right here, Tuesday, right there, you want to trade in there, I'll use a fair value gap just as a show of momentum. So let's see, find one more. I'm not a fan of the Swiss pairs, but this one could work right here. But no, that's Thursday, Friday. I want to avoid that one. Let me try something a little more succinct. Let's go to a yen pair. Okay, so this might work. So again, same thing right here, leg one, right there. And leg two, right here. Okay, that's how you just scan it and see, you look for those M's, the high, then the next high, and then a move to the downside. It's the low, go to replay. And we just see if there's a gap above the prior day high. So I'll go down to the 15-minute. And if there isn't, then there just isn't. Now this one looks like there is. Like right in here. But let me see. Sometimes the indicator takes a little bit to populate. But I will go through the steps here real quick while it's populated here. Let me isolate everything. So this is obviously the high of the day right here, this candle. So that's our money candle. So I like to mark the low of that right there. The close below the money candle comes right here at 3:15 a.m. And the fair value gap indicator is taking its sweet time populating. But this, I can just spot it on my own. This right here is the fair value gap right there. That's the gap. Okay, if the indicator was working, those three dots right there just mean that it's not loading. But if the gap was working, it would be right there. So maybe it'll pop up before I finish this video. But if it doesn't, oh well, because I'm not trying to make this video too long. Let's see here. But yeah, like right in there. Let's see here. So okay, there it is. Well, there's one. Well, actually, this was another one. Let me get rid of this one. And another option that you do have as well, because it does look like this gap closed out, and you'll see that. Whereby, and let me show you a replay real quick just to show you what I mean. Let me go back a little more. it's still loading again. Okay, so here we go. All right. Okay, so the gap is the low of this green candle and the high of this doji candle right there. That's the fair value gap. That's the first fair gap that formed. So if I isolate that and then go forward, it does get closed above. Price comes back up, okay, and it closed above it right here. There will be times where it does close inside of it or above it, and then the gap disappears, but the trade still works out. If ever you decide, you know what, I think this trade may work out, the last line of defense is going to be the money candles high if you're short, or the money candles low if you're long. In this case, this is a short example. So this right here is the straight up non-negotiable. If price breaks the high, then you definitely need to get out. But if it doesn't, then if you want to stay in, you definitely can. So, but in this case here too, came back, then dropped like a rock. That will happen. Okay, and then another gap appears. All right, so there you go. But this high is definitely the non-negotiable. I say fair value gaps because of the fact that they offer smaller stop losses. But this is one where you could have just got back in. When price tanked here, if you'd have entered right here at 8 o'clock a.m., you still could have won. An entry right here. This is not the old, but this is the other system that I use. So really, sometimes you just got to follow the pair. An entry there still would have been profitable with a stop loss outside the range. So either way, if you lose this one or you get out because you're afraid if the fair value gap failed and the price eventually does play out, just get back in once it closes below the range, because once it closes below the range, you're expecting price to stay inside of it and drop down. And this one dropped for, well, I don't have my measurement here, but let me do this on a short position. Well, let me see if it would help if I had a short instead of long. Let me get rid of that one. And then let me wrap this up. Okay, so that entry there is at 20. You could have got a 1 to 2 on that one. Okay, with a 10 pip stop loss, 1 to 2. And it did drop further as we see the next day. If I just let this play out, the following day it just tanked, as you see there, right? So all the way to the candle range low. So you could have got even more. It could have been a 1 to 4 or 5, whatever. Okay, but the point is that it's just a price action that you're looking for. Okay, so once again, the first fair value gap that's created, you look for that, and then a plan B can also be trade inside the range. So you have to be flexible sometimes when it comes to trading the candle range theory. And again, if you just want to wait for price to break back inside the range, you can do that too. This is just another option for people. But pick one, do both. It's up to you. Stay flexible, experiment, just manage risk. That's still first and foremost rule number one. So I appreciate you watching. I appreciate your time and attention, and I hope you have a great rest of your day. Take care.